Preferred stock shares typically trade some capital appreciation for higher dividend yields. Here we'll look at the best preferred stock ETFs and why you might not want to use them. Preferred stock shares, as opposed to common stock, have preferential claim to dividend distributions, so preferred stock shares are popular among dividend investors. Preferred stock also has more stability than common stock. It exhibits aspects of common stock and bonds, and can be seen as somewhat of an in-between asset. Preferred shareholders trade voting rights for higher yields. Preferred stockholders also take priority in cases of financial troubles or liquidations. Preferred stock is ideal for low-risk investors seeking fixed, predictable dividend payments. Here we'll look at the best preferred stock ETFs. First up is PFF, the iShares Preferred and Income Securities ETF. PFF seeks to track the S&P US Preferred Stock Index, providing broad, diversified exposure to preferred stock traded on the New York Stock Exchange and NASDAQ. This fund has over $16 billion in assets and an expense ratio of 0.46%. Note that this ETF inherently overweights the financial sector due to its holdings. Next up is PGX, the Invesco Preferred ETF. Unlike PFF earlier, PGX screens for credit rating. Its holdings can thus be considered higher quality. This usually means lower volatility. PGX has historically had the lowest volatility of the three funds on this list. The fund seeks to track the ICE BofA ML Core Plus Fixed Rate Preferred Securities Index and has an expense ratio of 0.51%. Third and last on the list is PSK, the Spider Wells Fargo Preferred Stock ETF. PSK achieves arguably better diversification than the previous two funds because it limits any individual holdings to a 5% weight, meaning it's not financials heavy. PSK has had the smallest historical drawdown of the funds on this list. This ETF is comparatively less liquid, but is also slightly cheaper than the other two with an expense ratio of 0.45%. If I were choosing one of these, I would probably go with PGX from Invesco. You can see it in red in the backtest here. The slightly higher expense ratio seems like a worthy trade-off for its credit rating screen, and historically it has delivered the highest return with the lowest volatility, meaning it has the highest risk-adjusted return as measured by Sharpe of these funds. But should you buy preferred stocks? Probably not. Preferred stocks sound fancy and attractive, but don't get sucked in too quickly. First, preferred shares are still an equity investment. In the event of bankruptcy, a firm's debt holders are still getting paid before preferred shareholders. If a company is liquidated, the preferred shareholder is getting zilch. Recall that preferred stocks have aspects of bonds. Traditional bonds have a fixed maturity date. Preferred stocks don't. Preferred shares are like corporate bonds with a perpetual maturity. Talk about credit risk. Preferred stocks are also typically callable. I delved into why this stinks when I talked about convertible bonds. Basically, if interest rates fall, the investor's upside potential is capped because the issuer would just call the preferred stock. This creates an asymmetric risk-return profile for preferred stocks. That is, the callability basically cancels out any upside from long maturities. Furthermore, companies usually issue preferred stock as a way to avoid a credit downgrading from taking on more debt, or because they are simply unable to issue more debt. This alone should be a red flag. Lastly, while that fixed dividend sounds nice, and while preferred shareholders do have preferential claim to dividends, those dividends can still be deferred in periods of market turmoil, whereas conventional bond interest would be more reliable. Missed dividends due to suspension do not have to be made up later. The higher yield of preferred stocks does not adequately compensate the investor for these greater risks and inefficiencies. This doesn't even consider the fact that any investment vehicle for preferred stocks, like the funds we've discussed here, are pretty expensive. As usual, retail investors are probably wise to stick with traditional stocks and bonds.